is so confident about in the wake of the kind of risk off which is visible in the global market? I mean, it now looks almost certain that the US market is perhaps headed towards its recent lows, but our market is well above that. And in fact, we are very close to our recent highs instead of recent lows. Your thoughts?
Yeah, I think if you look at it, first of all, the domestic investors, I think they have been very resolute and consistent in investing in the domestic markets. I think if you look at the steady inflows which are there in the mutual funds and even the direct investing which is happening. So the confidence levels, one is under penetration which is there with the domestic investors as far as equity is concerned. I think they believe that the growth of the economy, etc., we are kind of oasis in this whole turmoil which is there in the global world, where US is under pressure, China is under pressure, and Europe is also struggling. But our country, with its domestic consumption being so strong, plus I think the policies of the government as far as encouraging manufacturing and the PLI schemes and also thrust on defense manufacturing, I think all this together is creating a very positive sentiment as far as domestic investors are concerned to invest in our markets from a medium-term perspective. And we have seen that despite the massive selling that from FPIs, which was there in the month of May-June, but domestic investors did not falter. They continued to be positive, and a fifth of buying by the FPIs in July, August, and we see that the indices are almost near their highs. So it's clearly the domestic investors' confidence which is driving the market.
Okay, domestic investors' confidence driving the market. Mr. Karwa, good morning. I remember when we spoke last month, you had highlighted that, there's a big tailwind in the banking sector with respect to a big pickup in credit growth. Earnings have also looked good and valuations are attractive. The sector has seen a huge rally since then. But at the moment, is the risk reward still favorable for investors in private banking? And what about PSUs? Do you have any confidence there?
Definitely, I think the whole banking space, yes, it has run up in the last few months, and there could be some consolidation. But the tailwinds are definitely there in the whole sector. I mean, the credit growth itself should be very strong. Balance sheets of most banks are also very strong, and they're in a position to lend. And rising interest rate environment obviously is much more profitable for the banking system. As far as risk reward is concerned, possibly the larger banks, they are very well discovered, and larger private banks, they are very well discovered, very well owned. They will definitely do well, but it will be the second tier private banks and maybe some of the public sector banks also, which should deliver maybe excess returns versus the large private banks. So I think investors should look to diversify their exposure in the banking sector and move from the top banks to maybe tier 2, tier 3 banks across market caps and across ownership structures for better returns. I mean, when there are tailwinds, then it is the smaller guys or the mid-sized guys who will possibly give you better returns from a capital market perspective.
On the banking names, then you're suggesting the tier 2 banks could be the ones in focus from now on. Hi, Krishna. Morning. Thanks so much for joining in. Well, what about from the cement space? Clearly the street is factoring in that the second half of the year is going to be much better. Quarter 2 is going to be a washout. Out there as well, would you be looking at the mid to smaller cap cement companies, or would you go for the larger names that are likely to get bigger and are likely to be on the prowl, picking up these smaller names?
So I think that is a sector which is going through consolidation and will continue to consolidate. I think it is better to stick to the larger names in that sector, and maybe some of these large mid-cap companies which have all India presence and ability to be participating in the consolidation. I think we have seen that the smaller cement companies which are regional based, I mean, the valuations may look attractive, but markets definitely believe that it is the larger players who have pan-India presence who will possibly give better returns. And yes, I think second half of the year is expected to do much better for these companies as input pressures, etc., come off and realizations also inch up.
Well, just one look at the market, it tells you once again that it's clearly the domestic economy stocks which are doing well. Cement is doing well, telecoms doing well. By the way, the block, there was one block which got executed on Bharti. Maybe that's the reason it was weak in the morning. I think that's now beginning to pick up. It's been one of the stronger stocks, of course. So that's beginning to make a bit of a comeback. NMDC, so many stocks doing well right now, and the mid cap index is now comfortably in the green. Advanced decline at about 2:1. Now, Krishna, in the broader market, we're beginning to see some unusual moves, right? Is it par for course, or are you getting a bit nervous about the kind of moves we're seeing in the mid and small cap space?
See, whenever retail participation increases, you're bound to see the breadth of the market increasing, and maybe some of the small cap and micro cap names also outperforming. But if you look at it from a 1 year perspective, the small cap indices are still underperforming the large cap indices. So there is still scope for the broad market to do well. But I think what you say is right, that you need to be very, very careful and vigilant as far as investing in small and micro caps are concerned. There could be some ramping up, etc., which could be happening in some of these names, and investors should be careful. So yeah, I think there have been some sharp moves, sometimes maybe not supported by fundamentals, and I'm sure the smart investors would use to exit such stocks if they are stuck in those companies. So yeah, we have to be very careful. But I think what is happening is that there are so many micro sectors where you see tailwinds coming in, and maybe the first rush, some of these stocks move up and then consolidate, and investors understand the story, and then there is a second round and third round of movement. So some of the sectors like capital goods or EPC companies, etc., or even microfinance business. So these are sectors which are small sectors, but you see many tailwinds in developing in these sectors. So maybe the stocks are reflecting that.
Okay. You have been very bullish on the entire auto space, and you said that there is still a bigger leg up left despite the rally that we've seen already. There are several pockets here. There's two-wheelers, four-wheelers, commercial vehicles. There's auto ancillaries which have done exceptionally well. Where do your preferences lie?
So within that, I think we believe that the commercial vehicle space, I think there is a decent tailwind in that segment, and coming out of 2-3 years of consolidation, as the economy picks up volumes, you should see a good pickup, and stocks in that sector should give better returns. In two-wheelers, we believe that niche players should possibly do much better than the market leaders. And passenger vehicles, we continue to be positive. And so basically the whole sector, we believe, yes, it has given 20-25% kind of return over the last 6 to 9 months. But still, it's early days. There could be some consolidation, but from here also it should deliver superior returns and outperform the benchmark Nifty.
All right, Krishna, what about the chemical space? Specialty chemicals did very, very well for the last couple of years or so, but those stocks have come off the peak. Now, some of the stocks have re-rated as well. How much more juice is there out there, or do you believe there are select specialty chemical themes that would continue to do well from here on?
So yeah, I think what is happening in specialty chemicals is that currently now you're realizing who are actually doing specialty chemicals business, and many of them were possibly kind of commodities, but were getting rated like specialty chemicals. From a medium-term perspective, the sector offers phenomenal growth opportunities, and we have seen some of the majors announcing massive capexes for the next 3 to 5 years. So from a medium-term perspective, these stocks do offer good investment opportunities. I think as far as the PE re-rating is concerned, that probably has been done with. So many of these companies are discounting, say, 2 years forward at around 25 times and 20 to 25 times earnings. So there is no scope for re-rating of this many of the companies. Earnings growth, yes, some of these companies are capable of growing by, say, 25 to 30% for the next 3-4 years. So yes, you can be good compounders from current levels, but you'll have to really search now for those multi-baggers in the segment. I think the segment has been well discovered.
Okay, well, look at Lombard now, ICICI Lombard. I mean, I was highlighting that as a stock to watch because, because there was this chatter of block deal, discussing it with Nimesh as well yesterday. It may still happen, of course, but at least in the morning it didn't happen. So yesterday's shorts perhaps are covering. The market, well, is in the green, but normally on days like today, there's a second dip as well. So you just want to be a bit cautious about that. Krishna, what about the insurance space? It looked like a bit of a compounder 2 years back, but over the last 2 years, there's been, quite a bit of worry. Of course, maybe LIC's listing didn't help, but overall, your thoughts on life, general, are you buying these stocks?
I think the segment has gone through a consolidation. I think during COVID time, many of these companies struggled with excessive claims, and the growth also in premium income, etc., was not as expected. But I think the price corrections have happened in most of the sector across the board. LIC listing is also behind it from a sector perspective. So from these levels, looking at the overall valuations and the growth prospects, be it life insurance, be it general insurance, I believe this is one segment that should be invested in. Do you think that these can be multi-baggers from here? Possibly no, but can they give you 15 to 20% compounded returns over the next 3 to 5 years? Definitely. So investors who don't have exposure to this segment should look to invest in some of the leaders, both in life as well as non-life.
Okay, well, Krishna, we'll leave it at that. Thanks a lot for joining in and speaking to CNBC TV 18. Have a great day.
Thank you very much.
Thanks a lot. Okay, that's the word coming in from the market master. The market, by the way, is not bad at all. It's cutting its losses, especially the mid-cap end of trade that is now trading in the green. And plenty of stocks actually across pockets are looking good. One space that we're going to focus on now is the tractor industry. Companies, in fact, their stocks have hit 52-week highs after recording a growth in August versus a double-digit fall in the preceding months. M&M tractor sales in August were up 1% year-on-year versus a fall of 14% in July and a fall of 13% in June.